Ajay Srivastava joins us. Ajay, well, we're staring at a perfect market and it's almost like a straight line. In geometry, you have to take a ruler and draw a straight line, and that's what's happening to markets.
Well, as you rightly summarized, if that kind of liquidity flows into any market, it doesn't matter how the economy is doing or not doing or whatever the things are. But the fact is, somebody is buying at the pace, frantic pace that we are seeing. And I think on the other hand, I think it's a good idea for domestic investors to also in cash and put some money in the bank, because the last time the index was at 13,000 plus, none of them in cash, and then the collapse happened, and then they ran through a major rough cycle. So I think it's a prudent strategy. It just depends upon your risk appetite and where the capital is. The global capital is available at 3% odd, so therefore you see the PE fund, everybody is leveraging like to the hilt. But for India, there is an important lesson. Let's not get very ebullient about it. Is inflation. Inflation is standing at the threshold. You saw the oil prices, $50 plus, Indian petrol prices, discounts are disappearing from the market for products, commodity prices. You saw Vedanta riding from where 90, 100 to 150 stock because of prices. So we are having a situation where I think it's a very, very bad news for savers. It's a wonderful news from equity investors today, but I think everybody tells us that savers are here for a big loss as inflation is going to climb. RBI said inflation is not the priority, so they are on their own with low interest rate products on FDs in the market, while the inflation is going to eat into. So good for equity, bad for investors and debt markets.
So what is good for equities? Let's talk about it. Assuming that moderate inflation is back, in the short term, the cyclical trade, which is buy metals, buy cement, buy industrials, is that trade back? Because if you're an entrepreneur, when you see visibility of demand and reasonable expectations of price uptick, you will start capex, and that's what has started.
I think so. You're right. I think your assessment is right. Even if it is, inflation adjusted is not so much, but the fact that optically the numbers will start to ride faster and faster in terms of inflation differential, I think it's a great news for the companies. And I keep saying that everything points toward the fact that the top 500,000 companies in India are going to gain a lot in terms of market share, access to capital, as well as now optically at least the sales line and the bottom line would start to go up at 10, 12, 15% growth would become a norm. If inflation is at 9, 10%, it's easy to believe that your EBITDA growth will be at 20% or thereabout. So suddenly when you have industries, everybody reporting 20, 25% growth in EBITDA, not the EBITDA percentages, that's a hell of a lot of number to chase, given the fact that you can raise capital today also at a reasonable price of 8 to 9% long term. And if you can get an EBITDA of 20%, asset to turnover even of 1, I think it's a great thing for any industry or any promoter to invest money.
When I look at social media, Twitter handles and the SMS I get, Ajay, I'm absolutely surprised with how everybody is so excited that ITC has gone higher. Last week ITC went to 215, 216, and suddenly everyone is saying, "Arey bola tha sasta hai, dekho value hai." What is your view on ITC? Would you pay importance to the ESG aspect, which is a big aspect for global investors, or you think ESG is something which is now priced in the current price of ITC?
Okay, one, the disclosure, we hold a fairly large position in ITC. To that extent, our views are colored towards what ITC looks like. See, ITC has suffered only for one reason. Is the management of the company, which has refused to understand economics, put money into destructive, absolutely asset like hotels, etc., which are an epitome to their own egos. I think that's where the company was run for egos of managing director, of the ex-managing director, unfortunately is no more with us, so I want to say more about that. But the fact is, hopefully, and that's what market expecting, ESG apart, I'll come to ESG. But the fact is, people are hoping that the new management, which is sitting there, will now listen to reason and start to taper down all the nonsensical expenditure they do, reward the shareholders, and build, and reasonably speaking, build scale back into the consumer sector, etc. So that's the fundamental expectation out of ITC. It is the cheapest stock by and large, if you after Vedanta perhaps, is the cheapest stock in the country on a fundamental basis with a good quality underlying businesses. So that's a fact. Now comes the ESG issue. See, ESG is just started. It's not the ending. The first time we're getting a flavor of what this thing can do to stocks of companies. And therefore, I would say that if they pursue this path, and they're the best place to pursue the path, unfortunately, tobacco, they can't do very much about it, but rest of the business they can, then we will see more and more of the investors coming into the stock, because this stock has not seen accumulation so far, whether FIs or basically retail accumulation, not FIs. So I think ESG will start to come impact. It is just the beginning. It doesn't happen in 48 hours. Re-rating takes place over 4 to 6 months. But I think you'll see major institutional interest in the stock coming in this year compared to the retail, which has done the heavy lifting in the past, but failed to lift the share price. So retail picked it up, but suffered. But now the big boys are going to come and bail out, or at least bail out the stock.
Ajay, looking at the kind of momentum we're seeing, are you, looking further into broader markets, new opportunities, seeing some potential there?
When we come to new opportunities, you look at the worst sector of the market is the PSU stocks and hope as hell that someday they will start to perform. They've done a little bit of their own little jig, but nothing much has happened to that one. So I think if you look at the pockets of where the value today lies, at the end of the day, the PSU perhaps the biggest bunch of shares. Number two is, I think you'll see the second bunch of buying in the pharma stocks come the new results when they start to come out. The stocks went up, they corrected, a lot of people booked profit. I think the second wave is going to buy. If you're asking for new themes to go to the market, I think infrastructure, some of the smaller companies in infrastructure, they would do well. And certainly let's not forget the air conditioning segment. I think that's one where stocks have gone up. It's not they're not gone up, but I think the big re-rating is still to happen in 2021. So the two air conditioning stocks in this country are by and large slated to be the monopoly winners in the game of tariffs and the issues of the stoppage of imports. So I think the only sector I see is, as I said, the block of PSUs, metal companies. If you don't own it, you better own it. Whether it's Nalco, we have everything: Nalco, zinc, Vedanta. Plus Vedanta, the benefit of oil, of course, and we have a holding in that, so for disclosure. But so you don't need to go down the ladder. So don't go down the 500 crore below ladder. That's one. And don't go down the governance ladder. You saw what's happened to UPL share price. No recovery in sight.
Absolutely, and that's really been a story, UPL. Ajay, what about the financials in the broader market again? Mid-cap NBFCs, for example, other areas of financial names that perhaps could now start to see a climb higher. Some already have done so, but would that be an area you'd focus on?
Well, we have investments, so to that extent, do we add on? Perhaps we do add on. There are value stocks, like we have a holding ICICI Bank, I would still say is a value stock. It's not a growth stock by a margin. It doesn't grow at all at the end of the day. Its subsidiaries grow, but ICICI Bank doesn't grow, so it won't be qualified as a growth stock by and large, but it's a value stock. So if you like value stocks, I think it's a great pick to be there, because it's, if you take out the subsidiaries, the value is nothing. So financial as a space, and that's again, we have to look at what the RBI governor is saying. He's going to support it. He's going to give LTROs. He's going to give money at the cheapest price to the bank, who in turn are churning out AA bonds at 9%. Where in the world can a business you get where you're guaranteed raw material, which is money, at 4%, and you can easily lend at 8%? Now that's, so you just got to be there and not be stupid about it, and you make tons of money. So financial space is going to make tons and tons of money, and inflation goes up. They will make much more money, because you will find that the bond prices and the loan rates will go up faster than deposits, which are all locked in 1 year, 3 year, 5 years, whatever the numbers are, people are locked in. So banks are in a beautiful space given the RBI stance, which they have been in the 5 years. NBFCs, of course, because if the windows open for banking licenses, I think 4 or 5 of the NBFCs will definitely go to that. We already know the Aditya Birla Capital has brought in an ex-banker to head their company, global company, which gives you a pointer. So you could get in early there as well, perhaps. And of course, Tata would like to have a bank, definitely would like to have a bank. So I think the market of NBFC is about to perk up, not only for the reason of banking license, but also for amalgamations. As banks want, as say, for instance, Aditya Birla wants to be a bank, they will start to get 2-3 companies together, amalgamate, create size, maybe even buy up a smaller bank and get entry into the banking faster and so on. So I think the M&A market is very exciting for NBFCs at this point of time. Banks, don't lose sight of it. You got the big governor sitting for them, and he'll make you returns. So don't worry about banks. Keep adding, without a worry.
Sure. Ajay, in light of the Burger King listing today and the fact that it's already trading at 85% of the grey market, the premium that is, what is your view on the QSR space?
That's the beauty, This is one space which hardly makes any money. If you look at the EBITDA margin, if you look at the asset turnover, these businesses don't make money at the end of the day. Sure, Jubilant Foodwork has done wonders for equity investors. I will not discount that. Okay, that's been an outlier stock in India in this space in the last 10 years. And that gives you a story that what happens in this space. Westlife, yes, you're right, but what kind of returns you make. So my point to investors always been, that why do you really want to go invest in businesses? Same goes Dr. Bector, 15% EBITDA return. Now, that stock may still do well, but that's in a boom time. Come the corrections, come the slight wobbles. These are the stocks which collapse the first. And you really don't want to be there. Enough stocks with 20-25% EBITDA margins that you want to get into. Why do you want to invest in a 14-15% EBITDA margin stocks with a low asset turnover and who feed you cardboard burgers? Really, I'm sorry to say that, but that's what the taste looks like, cardboard to me. But don't sue me, please, Burger King, but that's what my personal taste is. So I'm not sure whether I am a great buyer of these businesses. I would rather have a more solid businesses with solid range, and there are enough options in the world. So QSR is a go as far as I'm concerned. Market may rise, go, you make your money out of IPO and then get the hell out of there.
Okay, not a burger fan, clearly. You just talked about earlier a block of PSU companies doing well. Again, given how large the PSU basket is, Ajay, what within PSUs interest you?
My largest holding at this point of time, I can I'm the largest holding. Okay, so because I believe that at 9,000 crores market cap, that's a great stock to be in. It doesn't have to do anything. Think about it. You just have to go dig in your backyard and make money. Now they've not been able to do that. That's because they're PSU at the end of the day. Even PSUs can't even dig in the backyard and make money. And the second largest, I would guess, is ONGC at this point of time. With the oil prices where they are, I would be on the ONGC side because they have both ONGC and HPCL refinery as well with them as a subsidiary. So between a metal stock as well as this one. The third largest I have is SAIL, of course, which has run up quite a bit. But I think it will see a lot of traction over time. And it perhaps, my view is, it will be one of the first companies in PSUs to be sold because there are so many buyers for that company at this point of time if SAIL gets sold, that the best prospect is, not even BPCL, is going to be SAIL. If the government sells it, it's going to get you great value, 4 to 5 times what it is today. If it doesn't, well, we'll live with dividends. So I think in these three stocks, we have seen the maximum value. We don't like NTPC. You look at 20-year track record of NTPC, it's been a dog, it'll remain a dog, and that's what it is. So please look at track records and then go for investment. So these top three picks, I would say control it. If you like refining companies, they're going to give you very good dividends. Believe me, they'll give you good dividend, but you'll have to sit with them for some time and hope that Vedanta gives a good price for BPCL.
If one looks at the texture of the market, between October and November, the mid and the small cap space has got re-rated. Now, typically a bull market always starts with narrow leadership of 4 or 5 stocks, then it goes to mid cap stocks and then small cap stocks, they rally. Assuming that the small cap bull market peaked out in 2018, it's been about 3 years, are we in for a 2014-15 kind of a scenario where mid and small cap stocks, they just went into a mega bull run, and before that, if you participated, you made good returns?
You're right, Nikunj. And the reason I say so is because there are so many wounded warriors on the side on these small caps. And there are hundreds of very marquee investor names as well who are sitting in these stocks, that by natural corollary, there will be a major push from all sides to convince investors to buy the stock, because all of them need to find an exit. The problem with small cap has been not the price alone, that people have not been able to exit those stocks. The volumes don't exist. So I think it's already happening in the market. There will be a definitely push by a lot of intermediaries to push this small cap market. But as I keep saying, that also tends to bring in if at all times, a rally to a little halt, if I'm not wrong, in the historical. But for investors, having burned very badly in the last time around in the small caps, that's why I said below 500, now you're playing with fire, because you are really playing a game where if you don't get a chair when the music stops, you are dead in the water for next 3 years. There is no hope for these companies in economic policy, market structure, credit policies, governance structures. There is absolutely no hope for these companies and investors to make money. You must be kidding me. That's companies made for promoters to make money, not for investors to make money. So you like to risk your capital, be my guest, but 9, 10 out of 10, you'll find that 2 winners and 8 losers are going to take care of your portfolio.
It is so, so true, Ajay, we may talk about this whole fascination of identifying the next multi-bagger, but frankly, when I started my career, the top 3 IT companies were TCS, Infosys, Wipro, and the pecking order really has not changed. The top private bank was ICICI Bank and HDFC Bank. That has not changed. The top metal company was Tata Steel. That has not changed. With the exception of a company like Indigo or a Bajaj Finance or a DMart, very few small and mid-cap companies have really given you those grand returns, and that is something which we must realize. Ajay, so what is a prudent strategy for 2021? Raise some cash as the year unwinds, prepare yourself for a nasty sell-off which could happen in and around budget, it could happen after budget, it could happen before budget, you don't know. But is it time to be prepared for that fall and then put your money to work? Or should one continue to ride? Because frankly, investors, Ajay, have 2 options. You can digest and prepare yourself for a 15-20% volatility, or you can sit on cash and wait for the correction.
See, it's a very peculiar dilemma, and coming from someone like to the market, to see that you really can't wait out. If you're a fund manager, you can't wait out at the end of the day, because the market is going up in a manner that defies, whatever it defies constant sense, logic, etc., not giving you a chance to correct itself or not giving you a chance to get in. Having said that, I think this is also offering you a great chance to rebalance your portfolios. I think that's the way that I would look at it, is rebalance your portfolio. See what mid-caps, small caps you carry in your portfolio, and be very harsh on your portfolio on the small and the mid-cap. There is no point worrying about an HDFC Bank or an ICICI Bank, okay? That's all about whether, you want to encash it. Tomorrow you may buy higher or lower. So I would not say family silver to be on the stake at this point of time. This is the point of time to take out the marginal cases where you're still in the money and get the money in the bank. Because if a correction happens, you really don't want to buy the bottom end of the market, which may fall 20% on a bad day, or a 30% in a week or so. You really want to go back and keep adding to your good quality portfolio, because that's what the market demands for 2021, and India demands. And more importantly, and I keep saying, take out market money from Indian markets and go overseas and start investing. If you don't have it, do it in the US market. You cannot have a portfolio which is 100% India centric. So one is, I would say to everybody, rebalance your portfolios at this point of time. Best opportunity, you'll never get better than this. Number 2 is get rid of mutual funds. That's ridiculous. Absolutely. Most mutual funds, if you're not have a good manager of mutual funds, and you are in, let me clarify. Get rid of your general mutual funds, which is your multi-cap and so on and so forth, because those are losers. Those are losers. You don't need to put your money there. Go stock specific and take your money out and put 25-30% in the US market. You would have balanced your portfolio. Don't look at India to balance your portfolio. Look at US to balance your portfolio.
That's a great point. That's where the magic's happened. And I'm not just talking about FANG stocks, guys. I'm just for the viewers. Keep the FANG stocks aside. There is a real magic which has happened in the non-FANG stocks also in the US market, because if the shape of the world is changing, you have to align yourself with innovation. And in India, innovation ain't happening, at least in a lot of pockets. So Ajay, closing comments. Which is one tech play? And I'm talking about the non-obvious names like Infosys, TCS, which you're happy to own based on technology or based on your understanding of the economy, which is one tech company in India you're happy to own for 3 to 5 years.
Okay, I don't know if you call it a tech company or not, but I certainly call it a tech company, is IndiaMart, right? I would love to own, and I own that stock, and I love to keep owning it. It's a tech as a stock, but that's where I want to be. There is no tech, as you rightly said. It's a strange fact. India doesn't have tech companies. India has service companies by and large. So if you want to buy tech companies, you go to the US and buy it. There is no point buying. In India, you need to buy consumer fulfillment tech company because that's what they make money. If you look at Naukri.com, etc., that's a consumer fulfillment tech company. You got to be there. Be there. It's expensive, but I think that's place. But I have put my money, a lot of money behind IndiaMart at this point of time because I think that's got a great future of industrial fulfillment backed by technology, and that's where the future is. And hopefully, as we see more and more, we will see more and more tech companies on the consumer fulfillment side coming into the market. We don't have too many IPOs or listed stocks in that space, barring these two names that I just mentioned. But that's where to be. Real technology, you don't buy in India, you buy overseas. And rather this, there are few players like Apple, etc., very expensive stocks, very small players in the Indian market. You don't want to go and risk your capital there. They're good companies. I'm not saying not good companies. But if you really want to buy the thing, then you rather go and buy a Roku or something in the US or, do investment in the US with so many innovation companies. So why do it in India? So I would say consumer industrial fulfillment tech companies are better than perhaps pure tech companies in India to invest.
Fantastic to have you back, and it's a great point. IndiaMart, after all, is a platform company.